There, see, it's got a little red flashing light. That's what I got to look for. We're going to do exercise number 4. It's the cost of goods sold in aspect of the income statement. So exercise number 4 on page 63. Schultz Company presents you with the following account balances taken from its December 31st, 2013 adjusted trial balance. So it's giving you a series of account balances, and it is also, because of what they have here, they have purchases and purchase returns and freight in. So that's telling you that they're using a periodic inventory system. Because under a perpetual inventory system, as you buy inventory, you're debiting the inventory account. You're not debiting a purchases account. Because the perpetual inventory system is always going to give you the accurate balance in inventory. Because every time you make a sale, you debit cost of goods sold and credit inventory. Every time you make a purchase, you credit directly the inventory account and then credit cash or accounts payable or whatever. So because they have purchases, it's telling you that you need to make the cost of goods sold entry at month end. Because otherwise there wouldn't be a purchases account. All right, so the calculation for that first is you're going to start with inventory on January 1. Which is $43,000. To that, you're going to add net purchases. So that's purchases of $100,000 plus freight in so this is any inventory that you purchased under terms of FOB shipping point. So you're buying inventory, but you're paying the freight. So that is part of the cost of your inventory, $5,000. So your total cost of purchases is $105,000. And then we've got some purchase returns, where we physically returned the inventory back to the supplier. $3,500. So that gives us net purchases. Now, the other thing you'd be subtracting from the total cost of purchases, if it was there, would be any allowances or any purchase discounts that you took, you know, the 2% for paying within 10 days would also come out of here in your calculation of net purchases, if they were around. So that's $101,500. Add that to the beginning balance as of January 1, you have $144,500. Is your cost of goods available for sale. Available for sale. Then you just subtract the ending inventory. Yep, it says in the problem. it says that it's additional data number 1. A physical count reveals ending inventory of 22,500 on December 31st, 2013. So 22,500 gives you 122,000 even as cost of goods sold. So this is the calculation that you make under a periodic inventory system every time you need to produce a financial statement, whether that's monthly, quarterly, or annually. However often that you need to actually issue financial statements, you've got to go through and do this count. You have to physically count everything that's left over. And the flaw with this system is that, yeah, you know what your purchase returns are, but you don't know what was shortage, what got broken, and your stock people hid. You know, they broke it and they quietly threw it away, because all you know is what was left, and you assume you sold everything, which may not be the case. All right?
So I have a question.
Yes?
Like, what happens in the case of like stolen goods?
That same thing. Shrinkage. That's just inventory shrinkage.
Well, how would that be calculated here?
You can't. You have no way of identifying it under a periodic inventory system. Yeah. So you don't know, which is one of the flaws. Which very few people, keep in mind, do this anymore, because you've got the ability now to barcode stuff. It's very, very simple to use a perpetual inventory system. I mean, even small little mom and pop stores can use it, because they just buy a point of sale software, and every time somebody checks out, they code it. And then at that point, you do cycle counts. So, because we'll talk about it when we get to inventory, but cycle counts are something that you just periodically go out and count a section, maybe a shelf or something, and then look to see what kind of variances that you have. And that way you don't have to do it all at once. You don't have to shut everybody down and stop your production line and stop your sales in order to do a physical inventory like they used to. I mean, you used to go up to stores and there'd be a sign on the wall, physical inventory closed for 2 days. I mean, you know, it's lunacy. But now you can do cycle counts. And the other thing, that it doesn't matter the industry, it's especially true in the aerospace business, but whatever the industry, normally about 10 to 15% of your line items make up 80 to 90% of the value. So in the aerospace business, I mean, you've got avionics units, you've got some very high dollar items. And even my wife, with the manufacturer that she works for that's headquartered here in town and has that operation in China, I told her, I said, well, sort everything by value and see where's the 90% of your total value. And it turned out to be far less than 10% of the line items. You want to count those every month. The high dollar stuff, keep track of, because that's what goes out the back door. People don't steal screws and bolts and washers. They steal the big stuff. So keep a real close track on that. Okay? All right, so now you're ready to do the income statement. So it's Schultz Company. So this measures activity, so it is for the year ending. It's not like the balance sheet we were doing last chapter. You're going to start with sales of $250,000. From that, you're going to subtract sales discounts. So you are offering your customers some sort of percentage off of their total invoice to get them to pay you early. So net sales are $248,000. In a multi-step income statement, which is what we're focusing on in this chapter, you're going to then create a series of subtotals that better inform the readers of your financial statement as to how you did. So cost of goods sold, we'll call this Schedule 1. We just calculated at $122,000. Subtract that from your net sales and you get your first subtotal of $126,000 gross profit. From that, you're going to subtract your operating expenses. From cost of goods sold?
No, for operating expense.
Well, expenses are automatically assumed to be a deduction. Yeah, when this is a contra sales account. When you've got contras like on the balance sheet, the contra asset account of the allowance for bad debts or the accumulated depreciation, then put less in front of it. But cost of goods sold and operating expenses and losses on sale of equipment and things like that are all assumed to be deductions.
So you still have the brackets now or no?
No. Well, yes and no. Let me get to it. All right, so selling expenses were $35,000. And general and administrative were $22,000. That gives us total operating expenses of $57,000. Now this I'm going to put brackets around because in this column over here, some numbers are positive, the sales numbers and the gross profit, net sales and the gross profit. So now I need to differentiate what is positive and what's negative. But over here, you don't need the brackets. So that gives us $69,000 as operating income. To that, you're going to add other items or subtract, depending upon whether they're positive or negative. These are items that are not part of your core business. It's not part of what you get up in the morning to do, but they may be sustainable. In other words, when you're trying to project out the next 5 years of income, things like interest expense may continue. Interest income, dividend income may continue, but it might not. So you need to separate this out from operating income because they may or may not be sustainable. So gain on sale of property, Selling a piece of property is not something you do on a regular basis. And then you've got interest expense. Of $4,000. So here once again I'm mixing positive numbers and negative numbers, so I need to put brackets around the negatives. So that gives us a net of other items of $3,000. Add that to our operating income, we get $72,000, which is income before income taxes and extraordinary items. Okay, so 72,000 is where we're sitting. From that, we're going to now calculate income taxes. They give us that. They 30% tax rate. So multiply the 72,000 times 30%, and we get 21,600 as income tax expense. Subtract that from our income before taxes and extraordinary items, and we get 50,400 as income before extraordinary items. Then we have an extraordinary gain. Extraordinary items, if you recall from last Wednesday, are both unusual and infrequent. So they have to be unusual in nature, and they have to occur infrequently. So this problem told us that it's an extraordinary item, and so it just says extraordinary gain pre-tax $23,000. But this $50,400 income before extraordinary items is now post-tax. We've taken the income tax out of it. So to add in this extraordinary gain of $23,000, we also have to make it post-tax. So this is going to be net of $6,900 income taxes. And that's 30% of $23,000. 30% of $23,000 is $6,900, which leaves us $16,100 as the extraordinary gain net of taxes. Does that make sense to everyone? I see the furrowed brow.
Oh, no, is that 6,900?
Yeah.
Okay, I didn't know.
Yeah. When I get down to the bottom, my handwriting, which goes from bad to worse. This is when I get, yeah, no, 6,900 income taxes. Add that to our income before extraordinary items, and we get a final total of 66,500 net income. So our subtotals, what makes this the multi-step income statement is the gross profit, the operating income, the income before income taxes and extraordinary items, the income before extraordinary items, and then net income. Okay? Questions on this one? Let's do one that's a little bit more complex now. Let's do problem number 21 on page 85. Has everybody got this? Problem number 21. And this one has a number of support schedules with it, so I'm going to do the support schedules first, and then I'll do the actual income statement. Problem 21 on page 85.
What did you call before the supporting?
Supporting schedules.
Okay, that's right.
Yeah. And it tells you in requirement number 1, supporting documents for number 2, which is prepare the multi-step income statement, is to prepare separate supporting schedules for cost of goods sold, which is similar to what we did in the exercise, selling expenses, general and administrative expenses, and depreciation expense. Okay? So we need to calculate those first and then feed those totals into the multi-step income statement in the appropriate spot. So let's start with Schedule 1. Cost of goods sold. Inventory on January 1 is $37,800. To that, we're going to add purchases. Once again, a periodic inventory system. 173,000. Add freight in. They're calling it transportation in, but it's the same. $13,500. And that gives us total cost of purchases of $186,500. From that, we're going to subtract the contra purchases account. Purchase discounts taken. Which is 4,100. And purchase returns and allowances. $6,200. Add those two together, you get a contra purchase total of $10,300. Subtract that from your total cost of purchases and you get net purchases. Of $176,200, add that to beginning inventory, you get $214,000 even of cost of goods sold, cost of goods available for sale. From that, we're going to subtract ending inventory. $34,100, giving us $179,900 as our cost of goods sold. Schedule 2. Selling expenses. We have sales commissions and salaries. $18,200. We have sales supplies. Used of $5,600. Delivery expenses. These are items that you're selling to your customer under the terms of FOB destination. So you're paying the freight to get it to your customer's place of business. $7,700. Promotion and advertising. $17,000. Now this is where your author ends selling expenses. I myself would add the $2,700 worth of bad debt in here. Because bad debt, in my mind, is a selling expense. It is the responsibility of the sales staff to ensure that they sell to credit-worthy customers. So if you ever get into a position where you can make that decision, I highly recommend it. It will not gain you any favors with the sales staff, but it will collect invoices. All right, so I'm going to end this here because this is where the textbook does it. Total selling expenses of $48,500. Schedule 3. It's to declutter the actual financial statement.
Oh, it's just breaking it down.
It's breaking it down. Otherwise, we would be going along. We'd go, gross sales, less sales returns and allowances, less sales discounts, net sales, and then we would have a cost of goods sold, and then we'd have inventory as of January, and you'd put all this stuff on the main income statement, and it would be cluttered. So you do supporting schedules to kind of clean it up a little bit. So now we'll just have one line item, cost of goods sold, to calculate gross profit, and then the same when we get to operating expenses, we'll have one line, total selling expenses, one line, total G&A expenses, and one line for total depreciation expenses. It just cleans it up a little bit. So general and administrative. So here's where your author puts their bad debt. Office supplies. So bad debt expenses were $2,700. Office supplies were $1,400. Insurance and property tax. $8,500. And general administrative salaries, or office and administrative.
What would you include in here, like if you had, say if you had like an office, you hired somebody or contracted somebody to come in and clean the office or something?
Cleaning supplies, general administrative, yeah. Unless they were cleaning the sales floor and, like your display counters and your actual sales floor, and then I'd put it up in selling. So, same with maintenance. Maintenance of the office would go under here. So, salaries were $32,000. Bringing the total to $44,600 total G&A.
Sorry, I have another question.
Uh-huh.
Why do you group insurance and property tax expense?
That's what they did.
Oh, okay.
I wouldn't.
I was going to do two separate things.
Yeah, but they gave it as one line.
Okay.
What if it was prepaid insurance though?
I mean, it said, well, still prepaid, you're taking to expense, and the expense would go here. So,
What if you did prepaid for more than a year?
well, you're going to take the expense allocable to the period.
Okay. Just
Yeah,
do that.
yeah, even if you prepaid it for, I mean, they've got insurance and property tax expense grouped as this 5,000. I don't know. It would be rare, yeah. I've never seen it, yeah. Okay. And then the last schedule is depreciation expense, Schedule 4. And you have buildings and office equipment. and sales equipment. So 14,500 on the buildings and office equipment, and then 9,600 for the sales equipment, for a total of 24,100 as your total depreciation expense. All right, so now we're ready to do the actual financial statement. I'll start over here and just to give you a chance to catch up on those last schedules. So the name of the company, name of the financial, and then the period. They're playing a video next door. They got to drown my voice out somehow, so they play videos a lot, whatever class that is. Because I'm sure my voice carries right through this wall. I'm absolutely positive of it. All right, we'll start with sales of $340,700. From that, we're going to take the revenue contra account of sales discounts taken, of $4,900, and sales returns and allowances. Of $12,100. That's a total of $17,000, which gives us $323,700 as net sales. From that, we're going to subtract the cost of goods sold, which we calculated in Schedule 1 as $179,900, which leaves us the first of the subtotals, $143,800. Gross profit. From the first of the subtotals, gross profit, we're going to subtract operating expenses. We got selling, which is Schedule 2. Of 48,500. We got G&A. I'm just going to abbreviate it. Which is Schedule 3. 44,600. And we have depreciation. Schedule 4. And that was 24,100. Add all those together, and we get total operating expenses of 117,200. Subtract that from the gross profit subtotal, and we get operating income of 26,600. From this, we're going to subtract other items. Subtract or add, depending upon whether it's positive or negative. Rent expense. I'm sorry, rent revenue, not rent expense. Rent revenue. Interest expense. And a loss on sale of office equipment.
Interest expense.
Yeah, so 6,900, a positive number for rent revenue. Interest expense was 3,700, and the loss was $5,000. Add all that together, and you're going to get a negative 1,800 for your total of other items.
What's the loss on?
Sale of office equipment. You find it? So this gives us our next subtotal, which is pre-tax income from continuing operations. $24,800, and that's the 26,600 minus the $1,800 of other items. And the problem once again tells us that the income tax rate is of 30%. So income tax expense, correct? Multiply the 24,800 by 30%, and you get 7,440. Which leaves us 17,360 income from continuing operations. So we're now at a post-tax number. So every item that we add or subtract from this point forward has to be net of taxes. So we have results from discontinued. We got loss from operations of discontinued Division B. So the loss from operations, so this is up until the time that we shut it down or sold it, which we know now that we sold it. It operated with a pre-tax operating loss of $8,700. So multiply the $8,700 and you get net of a $2,610 income tax credit. So that's a negative $6,090. Then down here in the additional information, we sold the Division R, not B. I put B up there. It's R. We sold it for a pre-tax gain of $10,000. Division R. So we now have a gain on sale of Division R. Division R, yeah, it was R all along. And this is going to be net of $3,000 income taxes. $7,000. Add those two together, you get a net positive from discontinued operations of $910. Add that to the income from continuing operations, and you get $18,270 income before extraordinary items. We don't know. We'll get 10 minutes. And then we have an extraordinary loss due to tornado. So we lost $12,000 due to an unusual and infrequent tornado, because that's the only way it can be defined as an extraordinary item. All right? It has to be unusual and infrequent. So this is going to be net of $3,600 income tax credit. Which leaves us $8,400 post-tax to subtract from the income before extraordinary items, and we get $9,870 as our net income.
So I have a question.
Yeah.
What happens if, like, you're in, let's say, Kansas, tornadoes happen?
They would not be infrequent. They would go in here under your other items. You'd have tornado loss, because it happens with, anything in Tornado Alley, all the way from Kansas all the way up through Indiana, would not meet the definition of an extraordinary item. It has to be unusual in nature and infrequent in occurrence.
What if your boss says they want you to put it under extraordinary item?
What if your boss says that he wants you to use gross sales rather than net sales? I mean, the income statements are yours, all right?
Where do you get the 8,400?
Okay, the total loss from the tornado was $12,000. It's item number 3 in the following information. Okay? Multiply the 12,000, one second. Multiply the 12,000 times 30% tax rate, you get $3,600 of income tax credit. Subtract that from the 12,000, leaves you 8,400. Okay? Yeah.
Okay. So if for some reason, like it says 20 years earlier, it said like maybe 10 or 5, then you make a decision.
It's a management decision in consultation with your outside auditors. 20 years, I feel, 10 years, I feel is infrequent. But like I said Wednesday, there's no hard and fast rule in U.S. GAAP that says if it occurs these number of years, then it's okay. It's extraordinary. We don't have that bright line rule.
Would you still get the tax credit if it wasn't frequent? Like if it was like
Oh yeah, whatever, any losses. I mean, any kind of losses you get to deduct from your taxes. Whether it's a bad debt loss, it's a loss on sale of equipment, loss on sale of a division, discontinued operation, anything you get to deduct. I mean, within reason.
you'll still do the net of whenever income tax credit is in the middle of your expense area, just like you did here?
Yes. Yeah. Man, this thing really chews up battery.